Well, a very good afternoon to you, ladies and gentlemen, and a warm welcome to this Personal Investing 101 series brought to you in partnership with Allan Gray. My name is Gugulethu Mfuphi, and I'm excited to have you join us for the fifth of a six-part edition of conversations where we have been demystifying the themes and concepts around investment, creating a great sense of excitement and curiosity as we look to engage and impart information with you regarding how best you can be a sustainable and successful long-term investor. We've been doing this by building up on a number of conversations and theories that we've hosted in the last few webinars. This is really focused in understanding the fundamental dynamics of why investing is important. We've also taken a look at the difference between investment managers and, of course, the role that they play together with certified financial planners. We've also reviewed what the different investment accounts are that you can access to meet both your short-term and long-term objectives. But today we're also going to take a look at not only building up on the theory and the concept that we shared with you previously regarding your role and your behavior as an investor, but we're getting you right up and front at the starting line. Ready, set, invest. We want to help you catapult your journey and begin investing to ensure that you build up the long-term success that you hope to acquire financially. Now, we do want to remind you, of course, that Allan Gray, whilst it is a recognized and highly reputable financial services authority in South Africa, what we are, though, is not able to share any financial advice with you. So during the process of today's webinar, should there be any questions that you have that might be rather personalized to your specific financial objectives, we'd like to strongly encourage you to reach out to a certified financial planner who will then be able to assist you with any financial objectives that might have to be tailored to your needs. However, at the same time, we do want to strongly encourage you to take a look at the Allan Gray website and, of course, engage with the information that is available in terms of building up your knowledge on all things to do with investment and, of course, understanding the themes and topics that we look to share with you today. But before we get started and before I introduce my guests, I do want you to make sure that your line is secure, because over the last few months of hosting webinars and participating in them, I think many of us are well aware of the fact that technology is a great friend, but it can be a fickle one too. So if at any time your internet service provider or stability of your connectivity actually disconnects and you're unable to participate in today's conversation, we'd like to strongly encourage you to go back to the Zoom insights and follow the protocols and prompts as to how to re-establish your connectivity and log back in to today's session. Now, most of us are working from remote environments, and every effort has been made to ensure that there's minimal noise and technical disruptions. However, should any of these disruptions occur, we would like to apologize for them and ask that you bear with us in, of course, navigating this landscape. And of course, if you do have any of your questions that you'd like to be addressed, please do feel free to make use of the Q&A service. It's available right at the bottom of the screen. Type in your question, and of course, myself and the panel will do the best that we can in order to address some of these questions for you today. But you've made time to join us for this conversation, even though the December and year-end fatigue is dragging you down. But I must tell you that you've done something good for yourself, because this will certainly set the tone as to how you enter 2021 and even wrapping up the year 2020 to ensure that you're on the right track to meet your financial goals and objectives, and specifically tailoring them to meet your needs. Joining me today for our webinar, I've got two guests from Allan Gray who will assist us with our topic, Ready, Set, Invest. I'd like to start off by introducing Mthobisi Mthimkhulu. He's the manager of private clients at Allan Gray, followed by Lise-Mari Crafford, who's the head of Manco distribution at Allan Gray. Well, I'm excited to speak to the both of you, especially because we are building up the penultimate conversation to really build a sense of encouragement to those who have joined us today to get investing and to participate quite actively. But Lise-Mari, let's start off with you. And maybe if we could take it back to the very first conversation that we had about why it's important to invest during this Personal Investing 101 webinar series. Perhaps could you refresh our memories as to why this is an important conversation for us to have? Why should we be discussing the concept of investing?
Thank you, Gugu. And yeah, it's lovely being with you today. So investing is an important tool in helping you secure the future that you dream of. For example, a comfortable retirement. Now, the stats that we get from National Treasury tells us that only 6% of South Africans are able to retire financially independent. That means 94% of South Africans are either partially or fully dependent on someone else to sustain them during their retirement. That someone being a family member or a friend or the government. So what does it mean to retire financially independent? It means that when you retire, you are able to sustain yourself with an income, call it a pension or a salary, that covers your living expenses, but it can also last you for the remainder of your lifetime during your retirement years. Now, unfortunately, very few South Africans, as we just heard, can do that. And there are probably multiple reasons for that. But a lot of that, I think, I believe, is because people are uninformed, or they delay the process and they end up just, I'll save next year, or I'll start, in 3 years' time when this is done or when that is done. And, you just end up not doing it at all. So I guess the key really to securing that future that you've always dreamed of is to invest consistently and regularly throughout your lifetime.
You raise a very important point in making sure that one is able to meet the objectives, but that raises the question then, Lise-Mari, as to what the difference between saving and investing actually is.
So, both refer to the act of putting your money away for a specific reason, but in my mind, saving is much more short-term focused. So, saving simply means you putting your money away in a safe place for a specific reason, for a future sort of purpose or for a future date, whereas investing is a much more intentional act of putting your money to work. So when you save, you kind of tend to save for short-term goals. You tend to put your money typically in a bank savings account where your money is safe, and where you've got easy access to it. Typically, you earn a bit of interest on that, but it doesn't shift meaningfully help you to reach your goals. Not if you're going to stay there for a long time. It's not going to make a massive contribution in terms of that. Whereas investing, as I mentioned, it's intentional. You can really think of it if you're putting your money into something, and that is going to grow it even more. So there's a wide range of investment options available. We're going to be touching on unit trust as an option today. Wide range of options that you can use to help you achieve your goals. Some of them including necessitating you to take on more risk than others. For example, if you've got a shorter time horizon, there are some that's suited for that. And if you've got 20 or 30 years to save, you've got different kind of investment options. So you can use investing to save for various different goals that you have, including, for example, saving for your child's education, saving for an emergency fund, building up a deposit for a home, and so forth. And I think I just also want to take a moment to just talk about the importance of saving for an emergency fund or investing towards that. It is the key, really. It's such an important part, and we so often forget to do that, because really what it means, if you are able to invest or save up for an emergency fund, it means that when a year like 2020 happens and maybe you had to take a salary cut and all those things happen, it means you don't need to take on excessive debt or expensive debt, or you don't need to dip into your longer term savings, perhaps, savings that you've saved up for your child's education. You can actually, you can use the money that you've saved for, an emergency, and that will obviously get you a long way to building up wealth over time by not dipping into the sort of the longer term savings that you had saved up.
Quite right. 2020 really taught us a lesson in managing our money more appropriately. And as a result, it's important that we have savings for various goals, as you've highlighted, which we'll come back to. But Mthobisi, I'd like to get you into the conversation here, because even when we think about the concept of investing, we always think that it's a game for people who are already moneyed, so to speak, or rather well off. But give us some perspective as to why this perception is actually flawed.
So, Gugulethu and everyone that has managed to tune in, the truth is that perception does exist, and many people do share that perception. I was fortunate enough in the few years that I've been with the firm to have the opportunity to travel around the country, educating South Africans about investing. And many, when you talk to them and you explain to them that you work for a company called Allan Gray, then you soon learn that many South Africans actually don't think or believe that they have enough money to invest with financial services companies like Allan Gray, which is flawed and untrue. Investing is for everyone. In fact, most of these companies have minimums that are affordable. Back at home among Gete, many still prefer to invest in livestock. So those working in the city, they prefer to send money home during the year to buy cows specifically and use that as a tool to grow their wealth. And I myself, like most young men growing up in KwaZulu-Natal, actually had the privilege, if I may call it that today, to look after our family cattle. And I can tell you this much, it's a lot of work. But what it really is a portfolio, an investment portfolio. And with that knowing and having witnessed growing up looking after our cattle, I'm convinced that majority of South Africans actually do understand the basic principles of investing that have been shared throughout this series. What they really do lack is access to information, as Lise-Mari touched. And I am actually fortunate that I'm part of a company, or I work for a company that's actually trying to go out there and educate people about investments.
Well, and that's why we have this webinar as well, to build up these conversations. And I like the example that you drew for us there, Mthobisi, about livestock, because it's something that we can relate to and has been part of our culture across the continent and the world over in terms of how investment work. But give us an understanding as to how it works when it comes to Allan Gray specifically. What's the magic formula as to what drives growth for these particular investments? And I guess if Allan Gray had a farm, what would be the options that we have if this had to be our investment world, an opportunity that we see?
Well, I guess our farm today is our limited range of unit trust funds that are available. So those who are looking to invest with Allan Gray, our clients, invest in our range of unit trust funds that we offer. And how these funds work, I think it's important to start by noting these are regulated investment solutions that allow everyday investors access to markets, to investment markets that maybe traditionally would not be able to access due to the minimums required and so on, right? And then these funds, so when someone is investing with Allan Gray, essentially they are buying a portion of this unit trust fund, which we can unpack during the conversation. So with every contribution that an investor is making, they are allocated a portion or a number of units from this fund that will then belong to them as their investment. So I guess in today's terms, so the unit trust units that one will buy at Allan Gray, you can think of them as the modern cows. And how this investment grows over time is that over time, as the price of those investments grow, so does the investment for that individual grows.
I'm glad you highlight this because it does remind us of a previous webinar we've hosted, focusing primarily on the difference between investment accounts that speak to your needs. Now, for the benefit of the audience, sometimes we call them investment accounts, or we call them investment funds, but essentially it is the underlying asset that you actually allocate your money to in order to meet either your short-term or long-term objectives. But staying with you, Mthobisi, you mentioned that there's growth that takes place with these investments. It makes sense when we think about a cow and a heifer giving birth to a calf, which then grows in itself to be a cow. But when it comes to our investments, I understand that there's an interesting calculator that works out what has been known as the eighth wonder of the world, compound interest. Give us an understanding and a visual representation of what that actually looks like.
Exactly. One does invest so that your money grows over time. In fact, maybe taking a step back. So a unit trust grows in two ways. So first, the number of units that's allocated to you, the price of those units over time grows, as I've started touching on. And that happens as the assets that are held within this unit trust fund grow over time. But secondly, the unit trust may allocate additional income to the investors, meaning that an investor who owns a number of units within the fund, they'll be given income, which then traditionally most investors will use that money to buy more units within the fund. But it's fair to say when it comes to investing, the biggest growth actually comes from the growth, the concept known as compound growth that you've touched on. And I always say this is really when time becomes an investor's best friend, because over time, the more time you have on your investment, then there's more time for your money to compound over time. We do have a very nice tool that we have available on our website. If you allow me just a few minutes that I would like to share. Let me see if I can share screen.
I guess as you're getting ready to share your screen with us and show us how this tool does work to our guests who have joined us for this webinar, we will be sharing a link with you as well to be able to access this particular page on the Allan Gray website so that you yourself can also work through the various tools to understand how they meet your specific objectives. But with Mthobisi, technology is on our side today. We see that you are on the Allan Gray website. Go ahead and show us how this value calculation tool actually works.
Perfect. So I figured I would start here on the Allan Gray website, which is www.allangray.co.za. That is the Allan Gray homepage. And then if you go to the search function on our screen, and then you can just search the investment value calculator, but it's actually one of the popular searches on our website. So if you just click on it, and we have this nice tool that we've built that really just kind of show you what your investment could be worth. And I think this is something that can inspire one as they think about their investment or achieving their goal. But more importantly, I think it's really going to help you make this point so that you can see where the growth start working for you on your investment. So let's say, as an example, maybe I'm going to say we're starting an investment where you're contributing on a monthly basis. Say you're contributing 1,000 Rand as an example. There you go. And I guess maybe to align with inflation where it is today, let's say you want every year so that your contribution also grows with CPI so that you're not left behind. And maybe perhaps, let's say with no lump sum for a period of about 20 years. And then here there's a nice section where it asks you in terms of what investments are you looking for. So maybe I'm going to pick an investment that's for more than 5 years to use in this example. And then what you see here is a nice illustration of how your investment would have grown over time. But really the point that I want to make is really right here. So as you can see on that block that we've shown there, over 20 years, there you go. You can see that your contribution that you made to this fund is about 322,000, but the investment growth of that investment, that's over 559,000. So really making that point that if you allow your money time and you allow it to grow over that period, most of your growth will come from the growth on your investment.
That's quite something to see because it actually gives us then a depiction of where the growth comes from versus our capital contribution, as well as the different subsets and headings you took us through. But Lise-Mari, I'd like to come back to you for a moment here because this goes back to something you highlighted at the beginning of our conversation, which is saving for different investment goals. And I'm hoping you can give us a quick refresher on some of those investments because truth is, sometimes we need money more urgently now, and sometimes we have bigger goals and objectives we want to achieve in a couple of years' time. And that can distort our thinking when it comes to knowing how long to keep money in a particular nest egg for. So give us, I guess, a breakdown of understanding how our investment goals then interpret or influence the kind of investment decisions that we should be making as to how long these goals should primarily last for and the money that we're saving for.
Thanks, Gugu. Yeah, look, I think your investment goals, it depends on your priorities in your life. So it will be different for different people. And I guess the time it will take you to reach those goals will also differ maybe from the time it will take your neighbor to reach the goals. But there are some generalizations that we can make. And that is that there are sort of 3 broad categories of goals, which you can call it defined as short-term, medium-term, and longer-term goals. Now, short-term goals are for shorter-term needs. They can be for planned expenses, but they can also be for the unplanned or sort of the unforeseen expenses, typically, with a 1 to 2 year time horizon, but I give nothing is exactly set in stone. But really, I think I spoke about the emergency fund earlier and the importance of that, but really saving towards these short-term goals really form the sort of foundation of your financial security. So it's really, really important to focus on that and to prioritize that kind of as a starting point. And I guess short-term goals can typically, as I mentioned, it can be something like an emergency fund. It can be things like replacing your car tires if you know that has to be done in a year from now, or there's some maintenance that you would need to do on your home. Painting is expensive, so you need to plan for it and budget for that. But it can also be things like maybe just working a little bit smarter with your money. For example, if you know that you're currently paying your school fees or your child's school fees via debit order, but actually if you pay a lump sum at the beginning of the year, you're going to save a lot of money. There's a lot of those kind of incentive structures that you can do, and so that means you want to save towards that lump sum for sort of early next year or the year after that. So that's kind of the shorter term savings goals. Then for the medium term savings goals, look, there's no fixed time period to it, but it's longer than the shorter, and it's shorter term goals, and typically it includes things like saving towards a deposit for your home possibly, or for a car, or possibly paying your car in cash, saving for a wedding. It can be saving for your unborn child's primary school education, sort of just typically like let's say 3 to 5 or 7 years, but there's no fixed period to it. It can also be longer, but that's kind of the goals that you're thinking when you think about medium-term goals. When I think long-term goals, I'm reminded of the stat that I gave earlier, and that's that as South Africans, our primary sort of long-term goal should be to save for our own retirement, and so that should be one of your most important long-term savings goals that you have, but obviously things like saving for your child's education when you've got a long time horizon, that's also a very important one. And there can be many other examples, but typically it will be for quite a long period of time. It might be a massive amount of money that when you think about it, it may seem overwhelming. And often that's why I believe people just never start, because they almost don't believe that they can achieve that. But I think the important message is that it is definitely possible. And from our own experience as well, is you save maybe a year, or you invest a year or 2 or 3, and you feel like it's not really moving the needle, but before you know it, 10 years goes by, and 13 years or 15 years, and you can see that you've actually started building up a nice little nest egg. So yes, goals are important. Goals can be very different and very unique, and I guess the time it takes you to reach those goals can also depend on, I guess, what you are able to contribute at the time as well.
You mentioned a very valid point there, Lise-Mari. Someone like myself who is 30 and thinks about retirement, it's a long way away, but it's the opportunity that I have now to actually save for those investments, even though a holiday might seem like something that I'd rather spend on versus putting some money away for retirement. But that also raises a very important question, right? Because we've got people of all ages who are keen to understand a little bit more about money and start their investment goals and objectives. And that leads us to a concept that we've also heard of in previous webinars: time in the market versus timing the market. And for those who might feel as though their time to reach retirement is a lot closer than what they had anticipated, some people might feel like it just might be too late for them to actually start on the investment journey. Would you say that that's a statement that could be true?
No, fortunately not. Look, Gugu, it's never ever too late to start. I guess, when I think about the golden rule, it's start as early as you can and invest as much as you can for as long as you can. That's when you think about investing, that's sort of the 3 things that's important to remember. But the reality is that many people maybe didn't start as early as they needed to for various reasons. Look, some just couldn't do that financially. There wasn't sort of a cent left to spare, and therefore they didn't do it. But the point is, what do you do about it now? And I think that's the good news, is that it's never too late to start. It may just mean that you need to adjust your values a little bit and probably contribute more, or delay sort of, let's use retirement as an example, delay retirement. Maybe you wanted to retire at 55, now it needs to be 65 as an example. So those are the things that you can do. So it's not impossible to do it. It will take a bit of sacrifice, either as I said, delaying the end goal or adding more, a bigger percentage of your monthly salary to that. And why it's so important is exactly what Mthobisi showed us earlier in that investment value calculator, and that is because of the power of compound interest, which is really growth upon growth or interest earning interest. And actually when you looked at that, he explained, or he showed to us, that there are two components to the final value, or to, when you look at the final value at the end of that 20-year term. The first component, that was your contributions that you made throughout the lifetime of your investment. And then the second component, that is really the kicker, and that is the growth upon growth. That's the compound interest. And really that's the benefit of time and time in the market, is that if you have long enough time, the sort of contribution, if you imagine 10, 20, 30, 40 years later, that portion makes relative to the contributions that you actually make is massive. It can be exponential. And that's the benefit of investing for the long term.
Quite right. It's that kicker effect. And of course, your cows having more cows and more baby cows, as we heard in the farm example from Mthobisi earlier on. I do want to remind those of you who have joined us online and of course stayed connected, that we are taking your questions. So if you do have any questions that you'd like to ask as to how you can kickstart your investment journey, or even amend it if you might find that you're not quite meeting your goals and objectives, feel free to put in your questions in the Q&A box, which is located right at the bottom of your screen. We'll be able to process your questions in just a few moments, as Mthobisi and Lise-Mari will give us some insight. Mthobisi, I'd like to come back to you because as Lise-Mari highlighted, we have different goals. They differ from person to person, but the beauty about the variety of investment accounts available out there is that they can meet and speak to our needs. Coming back to Allan Gray specifically, and someone who wants to invest with Allan Gray, how do they go about analyzing which investment account is the right one to invest there for their goals and their needs? And maybe if we can piggyback off of the theme that Lise-Mari highlighted, the short-term savings and investing versus something that's slightly more medium-term versus saving for one's retirement. How do I make sure that I can measure which investment account is best suited to my needs?
So I really like what the part that Lise-Mari has explained around goals, because that's where an investment decision has to start. It starts with one being clear on what they're trying to achieve with their money. And once that is the case, one is clear, now they're contacting Allan Gray saying that, Allan Gray, I want to invest. And that decision is actually a two-part decision, as you've touched on briefly. So the first part, and which was covered nicely on, is it episode 3 of the series? I remember Temren speaking to advising clients to think of investment accounts as the basket. She used an example of a shopping basket as an investment account, and then the underlying unit trust funds that one then invest in as the goods or the fruits that they'll buy, putting into that basket. There are a number of investment accounts that are available. There is the retirement annuity, which is designed for someone who's looking to save for their retirement. I think Lise-Mari touched on a couple of times, and I'm biased as well to do the same, especially when you hear numbers like only 6% of South Africans are able to retire comfortably at the end of their working life, which is concerning considering that many South Africans work hard. But there are also other investment accounts, like a tax-free investment account, which many like to use mainly for the benefits that the amount of money that they are able to invest in these accounts is tax-free. So they don't get to pay tax on it, even though there's some restrictions in terms of how much they can invest. There are unit trusts, endowments, and so on. But ideally, the decision on this investment account has to be largely based on the goal that that individual has for their investments. So if my goal, for example, is to invest in, I have this amount of money and this is my goal, is that I want to use this money buying my tire, a new set of tires in 12 months time. So that means I should be looking for an investment account that will allow me to access my money in 12 months time. Now, once I've chosen, let's say as an example, I decide to go with an open-ended unit trust investment account as my first decision. So within that investment account, now I get to say, so what unit trust or underlying unit trust fund do I want to use to allow me to grow my money during that time?
Valid point there, especially in terms of analyzing the time as well as the sustainability of it in terms of the investment that you make. But I'm also intrigued, Mthobisi, as you mentioned, you can choose the correct investment account and it has investments in underlying funds. And some might question, but how much will all of this cost me in terms of fees, which might concern some investors as to how best they need to manage this?
That is a very good question, and I always say that when you're selecting an investment, you need to take the time to understand what is it that you are investing in. And I've met many investors who would say it's complicated, it's confusing. Why don't you tell me what I should invest in? And I will caution them of such behavior because, well, it's your investment decision and there's a higher chance you are the one who needs to live with it for a long time as you wait to achieve your goal. And when it comes to fees or investment fees, there are a number of fees that an investor could potentially pay. And I think the first one, maybe perhaps that I would like to get out of the way is what is known as advisor fees. So let's say you have an independent financial advisor who's assisting you with your investments. That individual could charge you a fee for doing so. And that's usually something that is negotiable between you and your advisor in terms of how much you will pay. But essentially, they usually will take two fees, something known as an upfront fee or as an initial fee before the investment. That's a fee that they could potentially take on the investment. Others could take an annual fee, which is paid to them on a monthly basis. But what is key here is that this is a fee that's negotiable between you and your financial advisor for the services that they provide. Now, on the investment side, as investment companies, we charge an investment management fee that we charge on the solutions that we offer. And now this is a fee that will be disclosed on the minimum disclosure document or fund fact sheets as they are known, which are documents that I personally believe that no one should invest in a unit trust before they see these documents, because this document will give you information in terms of who is managing the fund, what is the objective of this fund that you are investing in. It will also show you information in terms of how has it performed in the past. But my personal favorite in this document is that it will even provide guidance in terms of who this fund is managed or designed for. So it will give you information like it's designed for someone who's looking to invest for this period and so on. And within these documents, then you'll clearly be able to see what fee or investment management fee that is being charged within that unit trust.
Valid points, especially in terms of us understanding what it is that we're putting our money into. There's a follow-up question as well that we have from one of our participants, Murodu, and perhaps Lise-Mari, you can address this one for us from the audience member. The question asks, I have inconsistent income, so I cannot commit to a monthly investment. Is there a product that could accommodate me without taking away from my long-term or short-term investment accounts? Inconsistent income, Lise-Mari, are there options for Murodu?
Yes, Gugu, there is. So you would have seen in the calculator that Mthobisi showed earlier, there was an option for a monthly debit order amount, but there was also what we call a lump sum or a once-off option. So for someone that maybe doesn't earn a monthly salary or that's sort of commission earns commission, paying via or investing via sort of once-off amounts every now and then might be a sort of a more suited or suitable option for that person. So in most of our products, including our retirement annuity product, our tax-free product, actually in all of our products, you are able to do both or a combination of both. So, the option might also be for this person to take a lower debit order amount and then every now and then you boost it with a nice lump sum contribution. So you're definitely able to do that. And just I also wanted to just add on what Mthobisi said earlier around the fees. When the other fee that you need to consider that you can consider, not with Allan Gray, but is the product fee or what we call the investment account fee. So at Allan Gray, we do not charge for that, but you need to just, I guess, keep your eyes open. It's not the same everywhere. Every offering is not exactly the same. So we do not charge what we call a wrapper fee or a product fee for that investment account, but really what you put into that account and the platform that it's traded on can charge you a fee, as well as then the advisor fee.
Makes a lot of sense. And it's important to ask questions, especially when one doesn't understand where these fees are going to or how they actually are accumulated. And those are questions that you can ask from the get-go before you take on your investment decision with a particular investment house. But because we're talking about Allan Gray specifically, and we have been focusing on unit trusts, and as we've highlighted, there's a variety of funds that one can invest in that speak to your individual needs. I'm already thrown off, Lise-Mari, by the number. I think for anyone who is introduced to the world of unit trusts, it can be intimidating because just like the analogy we made with the farm and cattle, there's well over 1,400 unit trusts available in the country. That is a huge number. But how does one actually go about identifying the right kind of unit trust to meet their needs and objectives, as you and Mthobisi have highlighted earlier?
You're right. I mean, if you're going to use that as a starting point and then try and choose the right unit trust fund for your investment account, I think it's going to be completely overwhelming, and it probably will also throw you off and, make you focus on sort of the wrong type of measures, maybe like short-term performance, and then you kind of pick the best fund. Which we would strongly advise against. Like, that shouldn't be your starting point. The starting point should be what sort of the why. Why are you saving? What's your goal? What's your timeline? And then figure out what's an appropriate investment product, and then what's the right sort of unit trust fund that matches your time horizon, your appetite for risk, for example, and that will then help you narrow down a little bit, step by step. It will become easier, and you filter out sort of the stuff that shouldn't work. But
stay with you there for a moment, Lise-Mari, if I may interrupt. It does remind us of a concept we've also learned in previous webinars, but do remind us, evaluating your risk and determining your risk appetite, what does that mean? And how does one evaluate this?
So determining your risk and your risk appetite is very important, because you can be a very, call it, aggressive investor that's willing to take on a lot of uncertainty and what we call volatility, which is fluctuations in the investment value, or you can be on the other side of the spectrum, a very conservative investor that gets incredibly anxious when the value of the investment fluctuates and go up and down over the short term. And then I guess you get something, there's like a whole spectrum, but there's something in the middle too. If you choose a unit trust fund, let's imagine you're a conservative investor that invests in a lot of, for example, riskier assets like shares, that goes up and down over the short term, depending on sentiment in the market, and maybe what Trump tweeted and those kind of things. I think it'll bring you an incredible amount of anxiousness, and you're probably then going to be doing the wrong thing. You're going to want to sell out, because you actually just can't stomach that, what we call volatility, the up and down movement. So it's important that you match your risk profile, that you find out, and there are tools that can help you, and obviously a financial advisor, independent financial advisor, can also guide you to determine what kind of risk profile you are. But that will help you, of course, to narrow down a range of funds, because if you're happy to take on that risk, then investing in a money market fund is just not going to cut it for you over the long term. Whereas for other people, that might be better for them, because it'll display what we call better investor behavior. Because the point is that you want to invest in a fund for the long term, if that's your goal, irrespective of what happens sort of with short-term volatility. But if you can't stomach that volatility, it's gonna lead you to sell out of that unit trust, and probably to make sort of a loss on your investment, and that's not what you want. So it's important to match that risk appetite to your goals. And then I guess the other important point is that there are a lot of unit trusts available, a lot of funds, but there are fewer fund managers. So it's also important to make sure that you pick a unit trust fund from a reputable fund manager that have built up a substantial track record over time, that have proven that they can stick to their philosophy, that they stick to their process, that they don't chop and change when, I guess, market environments change, because that's a very important part. You must be able to trust that your fund manager will do what they say they will do, and that's part of what Mthobisi referred to as the MDD, a minimum disclosure document, and the fund fact sheets. You can review all those things to determine that. And yeah, look, it might still be very overwhelming because yes, it will help you narrow down, but you'll still have a wide range of funds to choose from. And that's why we always say that if after all of this you still feel I'm not sure what I'm going to choose here, it's probably best to consult an independent financial advisor.
I like the example that you share with us because it reminds us of another concept we've learned through the Personal Investing 101 webinar series, which is volatility, right? And for many of us, we listen to the news headlines, we deliver those headlines, and we talk about the markets being up, the markets being down, the markets saw a crash and the markets have recovered. And as you say, all of that does speak to the sense of anxiety that you feel. And Mthobisi, I want to throw this one at you though. Given that we are investing, or sometimes unit trusts do have an opportunity to invest in equities as underlying assets, should an investor then realign the expectations to expect volatility from time to time? And maybe 2020 is a good example of that, given where we started in January, where the markets crashed to in March, and the recovery that we've seen since July to get us back to pre-lockdown levels.
Gugu, I would say yes. And I always say, especially when you are investing in companies, I think we all know companies, we work for them, we consume their brands. We know there are times where companies are doing well, but there are also times when they're not doing so well. And which is why I think for me, this really goes back to that part that Lise-Mari started on around just being clear on your goals and I guess your appetite as well in terms of your tolerance for this volatility. But even more so, once you are clear on your goal, I think for a longer term goal, let's say if I'm investing for 5 years or 10 years or even longer for my retirement, volatility today is probably meaningless because my goal is not today. It's in 5-10 years time. But how I really like to explain it when I'm speaking to clients, just to help them understand, to fully appreciate what it is and what it's not. I'll use an example of something that everyone understands very well. Let's say property, and I would say, let's say if you bought an apartment in Sandton for 1 million, I'm not sure if those are available today, but your investment then becomes that one apartment, but not 1 million. And I always stress this point because a number of investors tend to focus so much on the rand value of their investments, and let's say a year, maybe not even a year, a couple of months later, there's something that's happening in Sandton and the property market is affected negatively. Let's say that apartment that you own is now selling for 500,000. Now, and my question to that investor would be to say, have you lost money? And some will say, yes, I've lost money. But the answer is not really, because they are not invested in money, but they are invested in that one apartment. So they still have their investments. The opposite is also true. If that apartment, the price goes up to 1.5 million, have they made money? The answer is no, because they are not invested in money. So it's important to understand what is it that you are invested in so that it's easier to tolerate and understand what's happening in the short term, because the price is likely to change, especially if you are investing in companies.
Makes a lot of sense, and especially how it differs from the various asset classes, but of course staying in the market regardless of the volatility, because your goal is longer than what the noise is actually lasting for in the market. Mthobisi, I'd also like to stick with another question that we have had from one of our audience members, and this one asks, if I wish to save for more than one goal, e.g. saving for retirement and saving for an emergency fund, how then should I set up my investments to achieve this? I think this is quite an important question because it doesn't mean that you can put all your money in one basket and withdraw it as and when you need to. So what options are there available to invest or save for more than one goal?
I think that's a very good question. In fact, I think all of us probably have more than one goal. I don't think there's one person whose goal is to retire well. We have many other things that we wish to do in our lifetime that may require funds or money. So the idea, I guess, starting back to clarity on one's goals, and I always say, don't be shy to separate your goals, and call them what they are. This is a goal to change my cell phone in 6 months' time to get an upgrade. This is a goal number 2, to change my tires in 12 months time. This is goal number 3, maybe to save for a deposit for an apartment in 3 years time. This is a goal for my retirement in 20 years time. And then look for solutions for each goal separately. And sometimes you may find that, as an example, there are some goals that can be solved for with one solution. As an example, let's say a goal to upgrade your phone in 6 months' time with a goal to change your tires in 12 months' time. Clearly there you are looking for an investment solution that allows you access to your money, let's say, for both of those 2 goals within a year or 12 months. So one could choose maybe perhaps to invest in a unit trust, which is an open-ended investment that allows one flexibility, and maybe perhaps invest those monies in what is known as a money market fund, where their money is sitting in cash and they can easily access it whenever they want. And then for the other goals, someone could be looking at different solutions for those goals. So for me, I would say that thinking is exactly the same, and try and maybe perhaps think of your goals individually so that I guess it doesn't get too complicated, and maybe perhaps when life maybe, and I remember in my days in Johannesburg doing investment education, and you meet a lot of people where there's even an element of debt, that is now present in this plan. And that's something as well that needs to be solved for. So it's about, okay, we have debt, and let's say I owe EdCon 20,000 as an example, and then there needs to be a plan in place in terms of how to repay that back. So it's about thinking about each of your goals individually and finding an investment solution or a solution to each of those goals.
And that takes us back to a conversation we had in our previous webinar about understanding the relationship between yourself, how it is that you can structure those financial goals, especially if they become more complex, as Mthobisi has mentioned, with debt, with long-term goals, with managing your cash flow and other ambitions. And that's why you need to speak to a certified financial planner who will be able to give you solid financial advice and guide you on the best possible solutions. And that certified financial planner can then reach out to an investment manager like Allan Gray to help you in terms of separating your various investments and ensuring that you still meet your long-term goals and objectives. Well, I hope that many of you are quite excited and that you've been taking down notes as we've been giving you guidelines in terms of understanding the world of investments, understanding how this helps you align and reach your goals, and most importantly, identifying the various investment accounts that can help you along that journey. There's a plethora of them out there, but as long as you specify them according to your needs and of course have the internal discipline to keep up with your contributions, there's absolutely no reason why you shouldn't be a successful long-term investor. Well, we're still keen to take your questions, but we want to tackle the next part now of the conversation, which is essentially how to get started. We've planned through and walked through who we need to speak to, understanding the investment goals that we have, and maybe having an idea of the investment accounts that we need to open. But now it's time to open them. And Mthobisi, I think we'll start with you by really getting a perspective in terms of how to open up an investment account. What are the step-by-step methods that one needs to follow?
Now, it goes without saying, this is my favorite question, because I honestly think this is the easiest thing to do. Well, I guess in the rural KwaZulu-Natal, people prefer to just buy a cow. But if they were to prefer to use the solutions that are available through financial services, and in fact, I'm going to use Allan Gray as an example, these are companies that one can easily just contact. If I guess you prefer to do things the old way, as I may say, you can call Allan Gray. Our contact number through our client service center is 0860 000 654, or you can email us on info@allangray.co.za. But there are even easier ways to do this today. In fact, if I may, I will borrow just a few minutes just to take you guys through our tool that we have on our website, which we call Invest Now, that easily allows someone to open an investment with us. Let me see if I can get technology on my side. There you go.
Crossing fingers, we're holding thumbs, and it looks like we're all set to go.
Perfect. Thank you so much. So on our homepage again, which is www.allangray.co.za, we have a nice tool that we created called Invest Now. By clicking on this tool, and it's a fairly straightforward 5-step process where we walk you through the investment journey, and the questions are trying to go back to the two parts that we spoke about. First, you're selecting an investment account, and then secondly, you select a unit trust that you wish to use. So the first part, it says choose an account to match your objectives, a very key part, and a reminder to take you back to your goals as to why are you investing. And by this point, I'm assuming you are clear. You wish to start an investment that, say, in 2 years' time, you wish to go on holiday because the world will be open by then, let's say Bali, and then you go to your next page, and then you can see all the investment accounts being listed here. And there's a description of each account. So in terms of what it allows you to do. So let's say in this case, I could say I wish to start, because I wish to use these monies in 2 years' time. So I'm going to start a basic unit trust accounts, and then I won't go through each one of them, but you can see here, you can also see the minimums in terms of how much it will cost you, or you need to have to open an investment in these accounts. And then you click on Next, and then it takes you on the next page where now it's saying, select a unit trust that matches with your goals. And in this case, as an example, if I'm looking for an investment that I wish to use in 2 years, I could use the Allan Gray stable fund and then indicate the amount that I wish to contribute, let's say 1,000 Rand. And then it allows you to go on to the next page. And this is a page where now it will ask you for your details, and I will stop here for this example. But for me, I thought, let me show this tool because it's so easy to start an investment. You can open an investment in an hour. And maybe perhaps in conclusion, for those maybe perhaps who are unable to call or who don't feel comfortable, I'm going to stop sharing my screen now, who don't feel doing things online, because there are many who are like that. You can easily just walk into an Allan Gray office. And we have offices in Johannesburg, we have offices in Cape Town, in Durban, and in Pretoria, where you can walk in and there is an individual who can help you open an investment.
Makes a lot of sense. For those who aren't too digitally savvy, or just want to be a little bit more mindful of the investment that they're making and want that human interaction that is available. Now, we also do want to talk about some of the documentation. And Lise-Mari, I'm hoping that you can give us some guidelines, because like with opening up any kind of account, an investment account also needs specific information and detail for us to share with the institution to make sure that it's clear. Give us an understanding as to what kind of information might be required.
So the documents you're referring to is what we call FICA documents, and those are typically a copy of your ID document, a proof of residence, or proof of your bank account, you know, if we need to deduct the money, like for a debit order, for example. But I guess not to worry about it, because as you could see in the process that Mthobisi just showed you, at the end of that process, a form will generate, and that form will tell you exactly what outstanding requirements there still are and what documents you need to submit to us. So it will be typically one of those 3 documents, and then you can at that point use that to send an email to Allan Gray with the outstanding documents. But also, if you need a day or 2 to compile it or to get a copy of it, you can also send it afterwards. A consultant will give you a call or send you an email to remind you. So I guess it doesn't have to stop you from doing it right now.
I guess another important question, Lise-Mari, we've mentioned that investors can come directly to Allan Gray, but they can also make use of a certified financial planner. Is there a benefit to using one over the other, or are they both fairly direct and equal?
Look, in terms of from a client's perspective, from Allan Gray's perspective, the clients get exactly the same. So it's not that we have a special set of funds for the one group and not for the other group, or a special platform or anything like that. It's exactly the same. But I guess when you put yourself as a client in their shoes, I mean, we spoke about some of the complexity in terms of maybe selecting 1 or 2 unit trust funds from 1,400 and things like that, and that's where a financial advisor can really help you and guide you. I mean, a key role of a financial advisor is also to help you stay the course when you want to disinvest, when you feel like, like if we think back of how we felt in March when the markets crashed, many investors wanted to cash out, and a lot of them did. But actually, if you just waited a couple of weeks, your investment would have recovered. So a lot of, I think the value that a financial advisor gets or gives is really to help you display good behavior through remaining invested. But you can either come directly to Allan Gray, or you can do so through a financial advisor. You get the same.
You're quite right. Sometimes our behavior and our emotions catch us off guard and we think, I think I need to divest right now. So it's important to actually exercise discipline in maintaining our financial goals and objectives. Lise-Mari, another question though is, especially for investors who might have the discipline to contribute now, might see some of the volatility when it comes to hearing the noise in the market, how do they actually monitor the growth of their investment to make sure that they haven't just put their money into a black hole and are now forced to forget about it until they have to withdraw? Are there tools available where one can monitor the growth of their investment?
Yes, there are. So it's called an Allan Gray online account, which you can open the moment that you actually fill in that form to set up your investment, or you can do it at a later stage. And that will give you a view of your portfolio. It will give you a view of the balances, the different unit trust funds that you've got exposure to. You can also transact online. So that provides you with a great way of keeping an eye on your investments, but we also will send you a quarterly statement with your balances via email.
On that note of the quarterly statement, I'm just thinking of a question that might come into the mind of many of our viewers who are watching right now as to what kind of information they should look out for. And I say this because a lot of us might get heart palpitations when we see an underperformance and maybe get frustrated and might want to withdraw. Are there key elements we need to look out for in the statement? And even if the performance disappoints us, are there key questions we need to ask ourselves before actually withdrawing from one of those investment accounts?
So definitely. Look, I think we are obligated to send the statements quarterly, but it might not always be the best idea because, when you invest for the long term, it's almost better to forget about it. But there are questions that you can ask yourself if you see your statement. I mean, it's wonderful if the value of your investment goes up. It's not that great to see the value of your investment lower than it was the previous quarter. I guess what it might trigger for a lot of people is, oh, I think I've made a mistake. I need to switch funds. And that's what you were referring to earlier about timing the market to some extent. And that's a lot of people then want to switch to a fund that's performing better. But a lot of that is looking backwards. So what you need to do is make sure that the reason that you chose that fund and that your goal and all those things are still exactly aligned. If none of your plans and your goals and the reasons, the why for why you are investing have changed, if nothing material have changed with the fund manager and the mandate of the fund, then there probably isn't a reason for you to change anything. That is what we really just call a paper loss. On paper, and that's what Mthobisi explained beautifully earlier around the property example. You still own the property, you still own the units in the fund. The value of those units go up and down over the short term, and depending on how that quarter ended, it might give you a positive feeling or a negative feeling. But actually, you just need to allow enough time, especially if you're thinking like a longer term, medium to a longer term savings goals where you've taken on a little bit more risk. Maybe you've got a bit more, you're using maybe a balanced fund or an equity fund with more equity exposure. You should expect some volatility, some up and down fluctuations. It's not a bad thing. But really, the only time you should make, one of the only times you should make a change to your portfolio is really if something drastically changed in your life, your personal circumstances, or if something went very wrong, at the fund manager, for example, and that necessitates a change. So in most cases, just stick it out.
Sit on your hands and don't be driven by fear or greed when it comes to the market dynamics. Well, this is where we've come to in our conversation, where we've really set the tone for you to understand the importance of investing once again and how your investment opportunities need to speak to the goals and objectives that you want to meet. So it could be that holiday, it could be that fresh set of new tires, or even your child's education for the future. Whatever it is, there is an investment account that is able to meet those objectives, whether it be in the short or in the long term. It's imperative that you make sure that you speak to a certified financial planner to be able to assist you in navigating how to balance your money and, of course, your long-term investment goals, and, of course, understanding the available investment accounts that you can make use of in order to access and make these goals possible. And most importantly, once you understand the journey that you want to take on, go ahead and start. It's never too late. And most importantly, all that you need to exercise is the discipline of being consistent until you actually reach your goals and your investment accounts reach the fruition that you were looking for. So I hope that we've really set down the tone for you to not only reflect on 2020, but even before the year ends, you can actually get started on meeting your future goals and objectives.